Financial service firms succeed through people, expertise, and long-term client trust. That's why Harvard Business School offers an executive education program tailored to the opportunities and challenges professional service firms face today. In leading professional service firms, a 5-day program on the HBS Boston campus, senior leaders will focus on strengthening their strategy while delivering outstanding client service. Guided by real company examples, participants will examine how leading firms align partners, build culture, and sustain growth in competitive markets. Learn more at hbs.me/client. That's hbs.me/client. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Chris Tessin of Acuitas Investments. Chris is the managing partner and chief investment officer of the firm with over 30 years of investment industry experience. Prior to founding Acuitas, he served as a portfolio manager at Russell Investments with responsibility for all of the firm's U.S. micro and small cap products. Acuitas is a small and micro cap specialist investment firm with approximately $1.4 billion in assets under management. Chris, welcome to the podcast. Chris, can you share with us today the history of the firm and how it was founded?
Yeah, sure. Well, we were founded on 1111 2011, first day. Basically, the goal of the firm was to create an investment firm that was a sort of an efficiency for institutional investors who wanted to allocate down the cap spectrum into the least efficient areas of the equity markets, namely small and micro cap. That was our unique focus. We had some heritage, as you mentioned, from Russell Investments. I was on the U.S. side, uh, responsible for sort of U.S. small cap, which was kind of micro cap through SMID cap. And my business partner also, founder Dennis Jensen, who's our director of research, also did manager research and portfolio management there. So we really thought we could create a boutique that focuses down the cap spectrum uniquely. We would be sort of the only multi-manager that I know of that uniquely focuses on small and micro cap. We don't go up the cap spectrum where there's more efficiency in the markets. And we look at small and micro cap globally. So we have expertise now in non-US as well as emerging markets.
And today, as we sit here today, what's the backdrop for investment in small and micro cap stocks, and does it differ in the U.S. versus internationally?
It does. It's really compelling, and interesting, especially, in the U.S. I'll note there's lots of opportunity in non-U.S. partly because of the breadth. You look at, for example, non-U.S. small cap, sort of more like 5,000 stocks compared to the U.S., where you're thinking, and people generally frame, small cap as like Russell 2000 as an example, a slightly more narrow universe. And if you throw out non-earners and some of the junkier stocks that a lot of active managers don't buy, it gets even more narrow. But the backdrop for small cap and micro cap in the U.S., it's really interesting right now. One, it's soaring, so it's leading the market. Lots of eyeballs are sort of being drawn to the space, um, attention from the returns. But under the hood, small cap has lagged for some time as large cap has led the market. And all of your, viewers know that the market's been very concentrated. We're looking for kind of more breadth in the market in general, but with that concentration in the largest stocks, the tech stocks, the Mag 7, that, et cetera, small cap has largely been left behind. So even with a really powerful, past year of leadership from the smaller stocks, we're still lagging. At the end of the first quarter, just as an example, I think micro cap was still lagging large cap by like 400 basis points annualized over 10 years, even though it had outperformed large cap by 30+%, in the past year.
And do you think there's still some aspect of micro to small cap that is either misperceived or sort of underappreciated by the market and investors?
Absolutely. And a part of that is just because it doesn't scale. And in this business, scalability matters, especially in the world if you're not getting performance fees. Products that want to be larger, it's hard for a large firm to manage small cap products that will close at a billion or a few $1 billion in assets. Capacity matters. So So there are fewer products down the cap spectrum, and if you look into microcap, that's even more pronounced. There are very few very large firms, asset managers that have really compelling microcap products because they don't believe it scales. They think if they could manage 500 million or even push things and manage $1 billion in it, it really doesn't move the needle for them. Um, so there are fewer products, which I think helps support our efforts, and that having someone who scans and scours the market for leading investors and does the research on the underlying managers, both fundamental and quantitative, to find the greats. You really have to turn over a lot of rocks because it isn't like sort of large cap where everybody has a product.
And you referenced it before, cycles in performance. So we've obviously had periods of strong outperformance and some underperformance. What are some of the lessons to take away from events like the global financial crisis, COVID?
Yeah, I think a couple things. One is just, there's the nature of rebalance, which is the natural way to sort of, buy low and sell high, but it's contrary to what most institutional investors do, whether it's pension consultants or plan sponsors, public, private plans, you name it. Eyeballs are often drawn to excess return and to strong total returns, and so people tend to chase what works. Um, and there's powerful mean reversion in the market. So if you take a manager who's top decile, you take, for example, here's a manager that we know really well that won last year in a very difficult environment for active management because it was a lower quality leadership environment. But there were some things that were working really well. And so, for example, um, material stocks and energy stocks and those sorts of things have done well. So a manager that has an overweight to those areas is going to be kind of at the top of the tables. Now they'll be drawing assets from institutional investors because eyeballs are drawn to their performance and their excess return. And this happens whether it's great financial crisis or the internet bubble or wherever it was. It's like buying a manager who owned a ton of tech stocks during the internet period. Um, Everyone thinks they're a genius until the bubble bursts and they get the other side of it. So there's this a discipline that's required. I think one of the lessons is maintaining discipline, understanding the drivers of return for these managers, um, what led to their outperformance and underperformance. So a lot of it is kind of determining, what animal do I have here? Is this an antelope? Is it a zebra? Is it a dolphin? What environment are they going to do well in? And if you look at their returns, can you put them in context so that you understand that yes, a manager who's underperformed and may still be an outstanding investor that over a market cycle is going to win, but they just came through a really difficult environment for their substyle. It kind of takes the research. I mean, you have to dig in, as you know. You have some background in small cap, and this is an area where you are rewarded for the research, just like you are with the underlying stocks. It's the same in manager research that you find the drivers of return and you stay disciplined regardless of the environment that you're in.
And what about the macro? I mean, obviously interest rates, inflation, the consumer. I mean, those broadly influence a lot of sectors and a lot of market caps. Is it any different for small and micro cap?
Yeah, it is. The it can be sort of dramatic and the swings sometimes. Small and micro cap can act as sort of the tip of the whip sometimes when it comes to um, the short-term volatility around announcements, whether it's wars on, wars off, tariffs on, tariffs off, those sorts of events. They tend to lead to pretty dramatic returns, and it can be both up and down. Over time, we think that there's a modest small cap premium, but really we're looking for the active return. That's where we think you benefit from it. That's where we think that managers can deliver over time. But the macro is influential, and so in environments like this, whether it's energy and around the Iraq War, high oil prices coming back, war on, war off, these things are impactful for small cap. Small cap, there are some notable characteristics of small cap relative to large. You have more domestic sources of income for these smaller cap businesses. Smaller cap businesses can be more sensitive to input costs and supply chain disruptions, but a lot of them are also benefiting from, reshoring trends and increased domestic investment. So those are some things that are tailwinds for this space. Whereas large cap is increasingly being driven by narrow sort of AI related investing and tech.
And just you just touched on it, the narrowing of the market in the broader market. Is that just broadly, is that concerning to you that that's the way the market is sort of it's been an up market, but that's really what's been driving it?
Yeah, and this historically, our view is this typically happens, breadth um, will help the smaller stocks and will help the active managers. And the very narrow environment serves as a headwind. If I had to say anything, if you're a plan sponsor and you have some, let's say you have like a quality growth manager, for example, that's an area that's really struggled in the last year. Don't go fire your quality growth manager because they struggled last year. It wasn't the environment for them. It's not a big surprise. Um, um, but the kinds of managers, that are winning, it was reasonably narrow. It was more momentum focused. It was people buying what's working. And there were some great high growth managers that had some outsized returns. Um, so historically, when leadership broadens beyond a very narrow group of kind of mega cap stocks or a narrow group of stocks, flows go into more undervalued and underowned areas of the market. And that's where small cap can benefit. And we've seen this happen before, but it just appears to be, more dramatic every time we go through it.
And moving into the discovery process, how the rise of artificial intelligence, can you share with us how you might be using it or how you're seeing your investment managers use it?
Yeah, managers are using AI in a host of ways. There are, I think, the simplest version, and it's still reasonably early days, is that folks are embracing it as an efficiency tool, as a way to gather information. Um, and and there is work that can be done that normally might have been done by more, junior investment folks, or everything from uh, you know, uh, sales. I saw somebody recently take a picture of a conference and just ask who's here, who owns what, who has managers that are outperforming, underperforming, who owns managers in this space, et cetera, and just, and boom, um, they have the information. You don't even need to build agents for some of these things. Some of the managers are actively incorporating it into their process. No one is really, or few people in our world, managers that we evaluate, are having it make any decisions for them. And by decisions, I mean actual the stock picking. But they are incorporating it into the research process, and it's an incredible efficiency gain. So from quantitative managers who have embraced machine learning for decades and are now having AI tools that are accelerating things that they can do, to fundamental managers that are drawing from, using large language models to draw from 10Ks and 10Qs and get more information about a company, or a primer on a company, or a primer on it's never been easier to get up to speed as an analyst.
And has that filled the void of what's gone on in sell side coverage, would you say, or more than filled the void?
Yeah, it's interesting. I mean, and I spent some time on the sell side as well, as I think you did as well. And it's like sell side is like the book, Chronicle of a Death Foretold. It is it has been talked about as sort of a dying area for many, many years. But that said, there's always good value in folks that focus and deliver outstanding research. The research doesn't pay in the same way that it used to, just like when it separated sort of from banking and then moved on to, people letting go of smaller coverage. There's less analyst coverage on smaller stocks now than there used to be. I think that's likely to continue and potentially expand. That means that there's opportunity for investment managers to find undiscovered gems, because there's a really powerful discovery effect down the cap spectrum, especially in areas like microcap and small cap. If it's underowned, it doesn't have really quality coverage, folks don't know about it. It executes on its business plan, generates the earnings, and then gets some visibility in the market and potentially picks up coverage somewhere. That can be really powerful as an active manager who does great work early. But that said, there's no question that there's less sell side coverage than there used to be, and it's likely to be impacted by AI.
And now a word from our sponsor. If you work in a financial services firm, this program could be worth a look for you or someone on your leadership team. Harvard Business School offers an executive education program called Leading Professional Service Firms, a 5-day in-person experience held on their campus in Boston. The program is built around real-world examples and is designed for senior leaders dealing with the day-to-day realities of professional service organizations, setting strategy, developing talent, and managing client relationships. You'll spend time working through real company challenges, looking at how firms align partners, build culture, and continue to grow in competitive markets. To learn more, visit hbs.me/client. That's hbs.me/client. Can you share with us what you think some of the more compelling investment themes are in the smaller microcap space at a high level?
Yeah, I think there are a host of things happening right now in small and micro cap. Um, there, in as far as themes in the space, we're seeing a lot of opportunity and energy. If you look at the leadership in the first quarter, for example, it wasn't a big total return quarter. Second quarter has been, but a lot of the things that are being rewarded are around energy, defense, technology. There's more fear around areas like the consumer. In healthcare, there's been a good amount of M&A, and last year, in the more perhaps speculative areas of kind of biotech and pharma, there were some really powerful returns there. But there's also been a lot of activity um, uh, from large firms engaging in M&A and and making those targets look more compelling. So there are some really key themes that sort of run through small cap. Um, we're really looking forward to kind of the market to broaden additionally, but there are already really compelling. I mean, small cap is more of a ground war. You go name by name, and a lot of investment managers that are fundamentally focused and bottom up stock pickers that are not focused on as much on the macro, but really going through name by name, they find compelling names in all spaces. Even restaurant chains where there's a lot of fear about the consumer with higher oil prices acting as a tax. There are still some great names that are expanding stores and growing and generating great returns with good management teams. It's interesting. Managers tend to sort of if you're in the manager research area, a lot of them tend to sound the same over time. They tend to talk about quality businesses with good balance sheets and good management and all those sort of things. And it's like, at reasonable valuations. And it sounds great. It's like, yeah, shoot that in. That just seems like it's a winning formula. And everyone sort of has their own twist on it. Um, in down and small and micro cap, some of those characteristics actually pay more than they do in large cap. So, for example, having less debt on the balance sheet in a micro cap stock means that you're further from bankruptcy, whereas large cap, you may be using that debt to, build factories and build out your sales force or do those sorts of things that can help generate growth. So the quality factor actually sort of pays more down in small and micro cap. And fundamental managers that really dig in and gauge quality down the cap spectrum are more rewarded for it over time, in our view.
What about also, Chris, back on themes, private equity? What's the current stance of private equity in sort of the small and micro cap space?
Yeah, I mean, private equity has drawn a lot of attention and assets away from equity markets. Um, and it's become very crowded. Um, And it's interesting because I think some of our managers benefit from private equity buyers of their stocks. You're able to buy stocks in public markets in some cases at cheaper valuations than the private folks are paying for them to take them out. So you're seeing these large premiums on takeouts in small and micro cap. Um, and a lot of it is because there is a lot of private money there, companies being taken private from the public markets. There's a lot of talk about, nothing's public anymore, nothing's coming public anymore. We think that's overstated. There are definitely the IPO cycle absolutely waxes and wanes. Um, and and we have seen some activity this year in the IPO markets, but some of those names do jump over, and the ones that get the most attention tend to be the very large names. They are they're not the sub billion dollar or sub $5 billion market cap names that get the headlines um, in the newspapers. So the, I think that the belief that folks are skipping small cap is a little misguided. I think there's a lot of money, maybe too much money chasing um, similar deals in private equity, and there's a lot of opportunity in the public markets. And really, what it comes down to is valuation to a degree that you can buy small cap stocks at better valuations than you can large cap stocks, and there's great opportunity um, in public markets where you have liquidity and visibility and measurability that you don't have to the same degree as the private markets.
What about the manager research process? What does that look like? Sort of the blocking and tackling of actually identifying managers that could become part of the portfolio.
Yeah, I think it really begins, the manager research process begins with idea generation, and idea generation is core to the entire effort. It means lots of digging, lots of meetings. Um, um, we had a consultant ask us once, how do you get to know a manager in just a single, in like a 1 hour meeting? And we were like, well, the 1 hour is like the handshake, that's the introduction. So you've got to do the basics, which is collect EDQs, get to know them, understand what they do, and all that sort of stuff. But that's like an analyst getting up to date on a sector, right? That's just the start of it. Then you have to really dig into their investment process and find out where they may actually have value over others. What is their true competitive advantage? Is there something that you can put your finger on? Because there are lots of smart people. There are lots of people that do very deep digging on stocks. There are lots of people that do hundreds of meetings a year on fundamentals or have quant processes that are very in depth and that most people won't even get their head around. Um, so you have to ask yourself what relative to other investment managers is the true competitive advantage. And it means turning over lots of rocks and spending lots of time, which is why we think the specialist approach down the cap spectrum in an area like small and micro cap, where the research, fundamental research as an example, is more rewarded. You're never going into a Microsoft Analyst Day with 500 others and hoping to, raise your hand and get a question answered. You're more likely to be able to get in contact with leadership, CFO, CEO type folks, and understand the trajectory and goals of the business. So that's in the manager research. It really just starts with the effort, and the other big part of it for us is removing some of the natural barriers. So not saying that a manager has to have, 100 million, 500 million in the product, not saying that they have to have 5 years of track record, being willing to evaluate them early. Because often what you get is if you are a allocator to investment managers, you will have investment managers come in and say, I have great 3 year performance, you should hire me. Well, you should also ask yourself as an allocator, who was there for that 3 year performance? Why wasn't I there for that 3 year performance? Why didn't I evaluate this day one and understand that this is a compelling product with the proper resources and to have a willingness to invest early? So that's something I think we've made a really aggressive push on, is understanding that sometimes the best returns result from a low asset base, from implementation advantages, and having a willingness to do the research on your own and be early, as opposed to waiting for the herd, I think can really help drive excess returns.
And what distinguishes in your mind sort of when you interview all these managers and you sort of spend time with them, an exceptional investment manager, a differentiated process, how does that sort of jump out to you? What do you look for?
Yeah, it can come in a whole host of ways. Um, Sometimes, it's an industry full of smart people. It is, and folks that are hyper aware of what others are doing. So it's easy to get, you know, especially with AI, probably in a weekend, you could build out a PowerPoint presentation of your process, investment philosophy, all that sort of thing, and hire an actor and sound great, right? In front of a room full of people. Um, but you have to go in depth into it. So it's more than just lip service to the process. It's what is underlying the decisions on stocks and the timing and spending time on, we might spend 2 hours on someone's sell discipline about, which will be very different for a deep value manager that might have a long runway looking for catalysts or a high growth manager that might have to, shoot stocks quickly because they trade at very high multiples and car crashes are much more dramatic. So you have to understand for the type of manager you're evaluating, what are the drivers of returns? And then you're going to go all the way from the process down into the individual stock level and talk a lot of names and insight and decision making. Because sometimes it's ruling things out of um, a manager may not have the resources for the process that they're engaged in. Um, um, you know, if a deep value manager tells you it takes me 5 minutes to get up to speed on a name, you might sort of scratch your head a little bit. Um, and if that's going to be a long-term, low turnover process holding for them. On the other hand, it might make more sense if a very high growth, high momentum manager can get up to speed very quickly on a name and they're looking for very specific characteristics. But you're going to have to spend a lot of time on portfolio construction, on sell discipline, on how they put names together, that sort of thing. So it's really understanding there are a whole host of factors that you need to evaluate in the manager, um, where they're great, and uh, and where they differentiate versus the herd.
And as you look into the portfolios of the managers you work with, are there particular characteristics that sort of uh, defines long-term compounders, companies that really can deliver significant return over time? Are there things qualitative or quantitative that stand out to you?
I think the biggest, from a factor perspective of characteristics of the holdings in aggregate. So in our business, what we do as a multi-manager is we're putting together managers and complementary portfolios. Um, and if you look at the characteristics of the portfolios, they differ in what they look for, but we feel like they're complementary in aggregate. And you dive into the characteristics of the portfolio, I think one of the areas, um, which is no secret, is quality. So higher ROE, ROA, lower levels of debt, et cetera, are characteristics that in aggregate you're going to have from the active management space. And that's actually something that pays over time. We talked earlier about what folks are drawn to. And last year, for example, lower quality paid. It was a lot of stocks with negative earnings were leading the market. Those are stocks that a lot of active managers don't buy or at least buy fewer of. Areas like biotech, for example, which many managers view as very binary. Some managers have specialists and expertise there that we can hire and balance portfolios with. But um, no question that it's largely underowned. So when you look at the characteristics of the companies that do well, a lot of managers, as we talked about, look for some similar characteristics of high quality management teams, which is a little bit harder to find down the cap spectrum in small and micro cap. Um, um, the stocks trading at reasonable valuations, which is not as hard to find down the cap spectrum because they are more cheaply valued than large cap stocks at this point and have lagged large cap stocks, even with the incredible outperformance, small and micro beating large and micro and small leading the market this year. They're still lagging on a longer term basis, the last 10 years. Um, So, the simple characteristics like quality growth and valuation are all incredibly important, but their impact differs a little bit down the cap spectrum.
And you touched on it just now, management. Small companies are often tied to their founders. Do you evaluate founder-led companies differently than, say, a professionally managed firm, where there are more outsiders really running the firm?
Well, for us in evaluating, I mean, I guess it's a little different with investment managers versus evaluating securities. And I also spent some time on the sell side of doing security analysis, but um, there are a lot of kind of founder-led companies down the cap spectrum. There are also sometimes really compelling catalysts for a stock could be new management, where a very successful CEO comes in and is engaged in a smaller cap company, and they've been successful up the cap spectrum, and now they're focused down the cap spectrum. They can take their expertise, and you don't always get uh, the most experienced management down in small and micro cap. Um, but again, sometimes these are billion-dollar companies. Um, they are not, in small cap and even in micro cap. They're not corner stores. So having that experience is a benefit, but we have all kinds of managers that don't care at all, don't talk to management. They just look at the results, quantitative managers that are gauging characteristics, and then deep fundamental managers that spend a lot of time and know the leadership by name and are looking for how they're going to actually execute. So it's sort of the maybe roundabout way to get to your question, but there are lots of ways to win.
And what triggers in terms of allocating capital, what triggers you to sort of increase an allocation to a manager versus pull back from a manager?
Yeah, this is an ongoing thing. When we're evaluating manager weights, we'll set weights when we allocate to a manager and target weights, and then we'll rebalance to target over time, especially in the markets like this where it can be very volatile and they can quickly reach their bands by when you have managers like last year in the market, folks that can win or lose by 30 to 50% ahead or behind the market. Um, so the rebalance piece is really important. Setting that target initially is also very important. And that takes, I think, some expertise in understanding exactly what that manager delivers for you. For example, a very high growth, high momentum manager might be a more modest weight, depending on the portfolio and the goals, but because they tend to win in more narrow environments. They can win by a lot, but they'll win in a more narrow environment. So if you just have an environment like 1999, where your growth manager who has a heavy overweight to tech has won, and tech turns, um, it may be time to take some off the table. So I feel like there's a benefit to being a bit of a natural contrarian when your manager wins. And this is part of it's a natural rebalance process, but it also may be more than just a rebalance of understanding the environment, that a narrow environment that led to extreme outsized positive returns. Be aware that it isn't always just brilliance. It is also um, uh, a function of the characteristics of the manager.
And is it risk management for your firm's approach? Is it just diversification of managers, or there's other ways in which risks are managed?
Well, it's interesting. One of the things about the multi-manager process is we want it to be very alpha focused, and this is core to kind of Acuitas and our discipline. Um, the and by that, I mean small and micro cap is not an area where you want to be massively risk control. It's not an area where you want to be passive, right? There are lots of folks that have been drawn to passive investing in large cap because of positive returns and more of a focus on private investments. And so down the cap spectrum is where we believe, and what's shown by the research, that active managers can win, and you want to let the sails out a little bit, to use an analogy. So um, we don't want to massively risk control these portfolios and bring tracking error down to next to nothing. We want managers that are active stock pickers that are generally more concentrated portfolios, And this is Acuitas discipline I'm talking about. Um, but risk management also means that we're pairing together complementary managers who do different things and win in different environments. And it takes an awareness of what the underlying manager does, not only the style that they're operating in, growth, value, and core, but also the substyle, because there's a whole spectrum within value, within growth, and even within core. It isn't as simple as the seesaw growth value with core as the fulcrum. You really need to understand the managers to start um, to be thoughtful about the weightings.
And Chris, stepping back from all this, we've touched on the macro, portfolio construction, manager selection. What is the playbook for 2026 for small and micro cap? How should investors approach that just broadly?
I think it's a really positive thing that eyes are being drawn to small and micro cap. I understand that it's the performance of that's doing it. Up 15% or so year to date, and having and sort of soaring in the and the you look at the past 1 year through a day or two ago, and microcap was up 60%. Russell 2000 was up 37% on the 1 year. These are really powerful returns that are drawing eyeballs and forcing people to rethink their allocations or under allocations to small cap. A lot of people have just said, I'll get some small cap from my all cap managers. But of course, it hasn't paid to have small over the past 10 years. So I think we're really excited about the prospects for small cap. And there are a whole host of reasons to allocate to the space. One is because it's the most compelling area for active management. If you're going to be active with your portfolios, down the cap spectrum and small and micro cap is really powerful. The other is that the prospects for small cap are still strong in our view. And a lot of it is not just the valuations, which are incredibly important and cheaper than large, but also the earnings picture. Over the past year, earnings expectations for small and micro cap stocks are higher than large cap. And so we're seeing it now. We had a company the other day that was up 25% on the day because they put up a great number, not because of speculation around what was happening or some news item, et cetera. It was earnings driven. That's what we want to see. And earnings expectations higher for small and micro cap is really part of what drives it. It doesn't need to be just the interest rate environment. It doesn't need to just be a risk on environment. We really think it's going to be driven by earnings and by some normalization from what's happened over the past 20 years.
Chris, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Financial service firms succeed through people, expertise, and long-term client trust. That's why Harvard Business School offers an executive education program tailored to the opportunities and challenges professional service firms face today. In leading professional service firms, a 5-day program on the HBS Boston campus, senior leaders will focus on strengthening their strategy while delivering outstanding client service. Guided by real company examples, participants will examine how leading firms align partners, build culture, and sustain growth in competitive markets. Learn more at hbs.me/client. That's hbs.me/client.